Excuse me. Hello, everyone. To start off our finance joint governance meeting, Mr. Justin Mancheri's here and with Hozak, Speck, Mutual, and Wood to present our audited financials.
Is this on? Everyone hear me okay? Okay. As Chris mentioned, my name is Justin Mancheri. I am the partner on the school district audit. Also with me is Taylor, the manager on the job. We are the district's local auditors. So what we're going to do, we have a 2-page summary of the full financial statements. The full financial statements are reaching close to about 100 pages nowadays. So we just want to touch upon some of the highlights here for the activity for 6/30/2025.
Thank you, by the way, for that.
To start with the independent auditors report. For 6/30/2025, we issued an unmodified opinion. What that means is the financial statements present fairly in all material respects with the basis of accounting. It's also known as a clean opinion. That is the type of opinion that you as a board, as a school district, and as administration are looking to receive, letting you know that as a part of our audit, no significant issues were encountered. And the numbers that you see that we will discuss had no material differences. Moving to the balance sheet for the fund balances, to start with the general fund. At year end, you had 4 categories of fund balance. Non-spendable fund balance of $2.1 million. That's basically just prepaid expenditures that will be expensed in the 25-26 year. There was committed fund balance is about $190,000, and that's committed for future retirement costs. Assigned fund balance of $21 million. A few categories here. That's future capital projects. That's future budgeted expenditures. And I believe some set aside for future debt payments as well. That gets you to the unassigned fund balance, about $7.2 million. That unassigned fund balance is right within the threshold that the state likes a school district your size to keep that unassigned fund balance at. That's total fund balance in the general fund, about $30.6 million. Moving on to the statement of revenues, expenditures, and changes. Yes.
I'm sorry, just a reminder for the new board members. So that number, it's important to know that that is a number as of June 30th of 2025. So it's important because I'll come back to that in the regular meeting.
Correct. Going to the statement of revenues, expenditures, and changes in fund balance, this is basically the profit and loss of the district for the general fund. Total revenues, about $107 million. Total expenditures, just shy of $105 million. And then we had other financing sources and uses, a net number of about $6 million. That's mainly made up of funds that are transferred to the capital projects fund as well. That gets you to a total change in fund balance for year end, a decrease of $3.7 million. When we look at how we got there from the budgeted numbers, in the back of the financials, there's about 6 pages that detail that in more detail, but revenues were over budget, about 2.7 or about $2.6 million. That number is slightly, it seems like a large number. That is mainly your interest earnings. When you're doing your budget, you have to be conservative on that interest number because you don't really know where the rates are going to go or how they're going to fluctuate throughout the year. So this year, Chris did, and the admin did a really good job of wisely, having those in good funds to get that number higher than budgeted. Expenditures were under budget, just shy of $1 million or 0.9%. To kind of give you guys some breakdown, when we look at all the schools we do, anything under 5% is a good job. Anything under 3% usually lets us know that the administration and the board passed a realistic budget, and then while they're doing that, they're managing that properly. Revenues are a little bit harder, obviously, with schools, but expenditures are the important one. So to be under 1% on a $105 million budget lets us know that it was a very realistic budget that was passed. And then the administration was doing a proper job throughout the year, tracking those numbers and making sure there was no overspending happening as well. Kind of breaking down the revenues a little bit more detail. Local revenues, about $83 million, mainly made up of your real estate taxes. State revenues, about $23 million. Federal revenues in the general fund, about $620,000. And then other financing sources, about $1.4 million. Expenditures, a little bit more categories. Instruction, obviously being the highest, about $62.7 million. Support services, just shy of $30 million. Some non-instructional services, about $2.6. Some capital expenditures, about $2,000 in the general fund. Debt service, about 9.5. That's going to include your principal and interest. And then other financing uses, as I mentioned, that is a transfer to the capital fund. If we go to that next page, as I just talked about the capital projects fund, the activity in that fund during the year, revenues about $600,000, expenditures about $4.1 million, and that's the various projects the school undertakes each year. And then the transfer that I mentioned from the general fund that came into that fund. So in that fund, you had a change in fund balance and increase about $3.9 million. So at 6/30/2025, in that fund, you had about $15.7 million. Now, a big item to point out here, with the capital projects fund, is there was just about $5.5 million in projects that were already approved that have not yet been started in 6/30/2025 that will be expensed in 25-26 year. So that number is slightly elevated, and that's just due to timing when those projects could get undertaken and completed in a timely fashion, basically. The school also has a food service fund. The big thing here for any board members, the food service fund, the ideally gets close to break even, so close to zero profit, zero loss each year. So when we look at the change in net position for this fund, 6/30/2025, about $26,000 in profit. So you're right exactly where the state kind of wants that fund to sit. And when you look at the previous year, about the $366,000, the federal government was doing additional reimbursements on meal prices as well in the 24 year. So obviously, as that stopped in 25, you can tell that fund is operating very properly for last year. Footnotes take up about 40 pages. A lot of them are just basic accounting policies and basic information. Some of the big numbers that I always like to touch upon, the biggest being the net pension liability. So the net pension liability is related to the PSERS retirement plan for any employees that are enrolled in that. And the school district, it's usually about 90% full-time employees are enrolled in that plan. Now, when you look at this number here, this net pension liability at year end, about $106 million, it seems like a very large number. A big item to note here is this is a proportionate share of the total PSERS plan liability. So at 6/30/2025, that total liability statewide is about $46 billion. Pine-Richland's percentage of that is 0.2%. The other thing I'd like to point out here, this is not a debt that you can pay down early or anything like that. The school is making all of their contractually required contributions per the PSERS plan doc. The reason we bring it up is if you are looking through the financial statements, it is a significantly large number that tends to, scare people a little bit. But over the 10-year plan that the PSERS retirement system has in place, as they continue to invest that, hopefully we'll see that liability continue to decrease. But kind of reiterate, the biggest thing here is that you are making all the payments that you're required to make per those plan documents. Moving to long-term debt, you do have general obligation bonds outstanding at 6/30/2025, about $77 million. During the year, $6.1 million of principal was paid down. And there is general obligation notes outstanding, about $6.4 million. During the year, about $155,000 of principal was paid down as well. Finally, the last section, the single audit section. The school did expend over $750,000 in federal expenditures. Because of that, we are required to complete a single audit. It's basically an additional audit over those federal funds that is required to get uploaded to the federal government. The total federal awards for the year was $1.5 million. With that, we have to choose a major program to test and do additional procedures on. We chose the special education cluster this year. The big thing to take away here is there was no compliance findings noted, no internal control material weaknesses or significant deficiencies for that as well. So for the lack of a better term, also a clean opinion with relation to the single audit as well. A big thank you to Chris, Dr. Miller, all the administration. When we come out, they kind of let us bother them for a number of days, in and out, and then, the follow-up that we have as well. They're always very open with us, answering any questions, and we really appreciate that. That was a very brief overview of a very large document. If there's any areas you guys would like me to go into in more information or more detail, I'd be happy to do that.
Mr. Vancherry, just if we scroll down a little bit on this first sheet where we see the 1.419 million with the other financing sources, that goes into our re-upping of our 5-year copier lease. So that's essentially an offset. So that's recorded as additional revenue, but also an additional expenditure.
Correct.
So that brings us even closer within, I think we're actually around 1.3% on revenue when we move that out.
Right. New to the new copier lease under GASB 87, which was put in place 2 years ago, we're required to now show a revenue as you entered into the full value of that contract and an expense in the year they were entered into.
Just a question, just in your opinion and of your review, anything stand out to you this year compared to prior years' reviews?
No, it's all Chris has done a great job, and especially, this year with a lot of the federal awards from the pandemic kind of slowly fading away. We do a number of schools. You guys have done a great job of trying to mitigate that and, have good forward thinking, instead of trying to play catch up at the end. And with everything that we look at, there was nothing that warranted a internal control letter or a management letter or anything like that.
Okay, thank you.
Mr. Jeswick, do you mind sharing a little bit about the food service, how that's different than the other funds?
So the food service is completely separate from the rest of our funds as it operates as it's notated as a proprietary fund. So it's almost like its own little small business. So anything that the food service fund brings in, it must be spent for food service related items. We do have the ability to make capital improvements with it, but that all must be within the food service department and approved by PD at that point. So an example, walk-in cooler or serving line we just did at the middle school, it has to be related. We cannot use that money anywhere else. It operates as its own little small business in a sense.
And we're required to, every 5 years, bid that out. I think we just did. When was the last time? A couple of years ago? Or last year?
It was last
This
year.
Yeah.
As we,
Chartwell's, this is the first year for Chartwell.
correct.
So, Mr. Ventura, I don't know if this is a Chris Juskowitz or a question for you, but on the $2.7 million over budget on revenue, so that's $2.7 million in excess of what we had anticipated, is that correct?
Well, that's
Yes, basically. So of that 2.7, like Chris said, if you look, I think interest earnings alone were $1 million over expectation.
in the one area where it's when I point out that 1.419, that is an offset with an expenditure we take. So in reality, it's probably more of a $1.3 million over what we budgeted revenue wise, and that was the interest portion Mr. Vancherry was talking about, and that leads us to about a 1.2, 1.3 difference being slightly over our projected revenue.
And in that 1.4, with in relation to the lease, that's not something that any school budgets for or anything like that.
No, I understand that, but so what, Chris, I don't want to get too far into the weeds here, but if you recall off the top of your head what our original budgeted number was for that line item? If you're telling me the revenue over the revenue over budget is 1.3 million, so what was our original number?
We budgeted $105,755,000 in revenue. If you remove that 1.419, which there is a offsetting expense in, we brought in $107,038,000. So about $1.283 million when you pull that 1.419 out, because at 1.49 there's also an offsetting expenditure.
Okay, so, and I'm just, maybe it's a more detailed conversation for another time, but I'm curious as to what the rate of return was and what was the principal balance that we were earning that money on as we look ahead to this coming year.
Well, it would be based on our cash flow, if you're stating with how we earn that interest and how we brought that in. Our cash flow hits very early in the year with the real estate revenue, and our expenditures our expenditures work up through the course of the school year as we get that heavy heavy base of real estate revenue is our big hitter.
So you were conservative, which obviously you should be in projecting that revenue.
I would say realistic versus conservative on the revenue if we're 1.3% off.
Either way,
Fair.
but we still ended up $1.3 million to the good. I'm curious what, if we know what the rate of return was to generate that 1.3, and can that be replicated, or any thoughts towards that?
I do not think it will be exact. Say in our 25-26 school year, if we pulled in between $2.6 and $2.7 million in interest, I budgeted close to 2.1 this year. Within those concerns were, and Mr. Miss City will kind of speak to this in the other side of the scenario with debt. Interest rates have been coming down. If you look at our monthly cash statement we provide each month that we approve on the statements with our cash balances through all our accounts and all our CDs, you can see those interest rates dipping, our money market dipping a little bit. And then the other end is we spend down the fund balance. We have the combination of kind of an inching down fund balance as we put it towards the capital projects, even though we've shown operating surpluses that we've been able to put towards the capital funds. The overall capital projects, we spend that down, lowest interest rates. I do not think we will be able to completely replicate it. We'll still be in a decent place this year in 25-26. I have about 2.1 million in interest. Next year, right now, I have about 1.8 million budgeted. Within that is laddering some of these CD investments that are 250,000 at a time, where I believe we're over 200,000 interest I have that will mature next year. So it's just being very strategic with all of it, but it is going to come down based on interest rates and fund balance.
Thank you.
No problem.
Okay, thank you. Good question, Mike. So thank you. Anything else on the audit?
Could I ask a quick question? You said a couple times that the state has that 7 million. Is that a minimum expectation?
Yeah, so
Okay, I just wanted for clarification.
Basically, what they suggest, and really the laws for your budget, when you budget, they require you to be no higher than a school year size 8% of unassigned budgeted fund balance. Now, realistically, no schools can operate if they only have 8% set aside, obviously. So really what the state likes to see, and kind of what you can see here, that unassigned, you keep that around 8%. And that's really just kind of for any unanticipated things that might come up throughout the year, unknown. And really the state wants to see that the other additional funds that might be in excess of that do have a purpose assigned to them, basically. And so that's why if you look at any districts, especially, districts that are continuing to put money back into their buildings and, other things like that, that assigned fund balance will be usually 2 to 3 times higher than the unassigned fund balance.
Thank you.
Mm-hmm.
Any other questions? Okay. Thank you, Mr. Bancheri.
Okay, thanks everybody.
Thank you.
All right, and Mr. Mercedes up next. Thank you for joining us again, Tony. Item 2.2, he'll cover the bond market and debt refinancing opportunities.
Thank you, and good evening, everybody, and always appreciate the opportunity and hope all is well, and a very large welcome to the new board members. Again, phenomenal district, have worked with Pine-Richland for a very long time, and I think as echoed by your auditors, it's always a pleasure to work with a very focused and directed team. And I think what we really wanted to accomplish here this evening is what we kind of do once a year, especially to make sure that everybody knew coming up the ladder with the debt side of the district and how capital is really provided for projects around the district. And that's not just shovels in the dirt for a new building or a new field, but also when it comes to additions, renovations, upgrades, things of that nature. Sometimes capital projects get to the point where they're large enough where paying cash does not work. Also, there's when you have an asset that is going to have a useful life of greater than 20 years, 25 years, 30 years, at least the frame the foundation, the brick and mortar components, you really want to match fund those assets. You want to make sure that the debt service and the way you're paying for it is going to really tie out with how long that property, that asset will be in use, as well as benefiting the constituents. So with that being said, we'll walk through this, and the beginning is about the debt service of the district currently, and then the end will be about the market and where refunding opportunities, really where they were throughout this year, and looking into calendar 2026. So with that being said, we'll flip through that if I can get, and for the new board members, this is your cure for insomnia. If you ever really have trouble falling asleep, open up regulatory disclosures, and you might get to the third bullet point and you'll be out like a light. So what we'll start here quickly is on page 2, and when you look, or excuse me, page 3, and that's the district's current debt profile. The different shading in there represents the current, for the full fiscal year, 12 bond issues that are outstanding, including the notes that were spoken of by the auditor. That very bright yellow bar in fiscal year 2026, that is gone now. That was fully paid off. So that issue is now completely matured, and the district has 11 issuances outstanding. And those will stay outstanding until fiscal year 2038 as of current structures. A very small component, a very minor payment is still due in fiscal 2038. And as you can see, what the district has done historically is approach its refundings with lowering annual debt service, therefore making room in its budget and basically lessening expenditures. And at the same time, they've also taken advantage of lower interest rates to shorten the overall term of the outstanding issues. And that's why you see a little remaining piece in 2038 and a lower overall aggregate bar there in 2037. The district's debt used to be a full bar in 2039. If you just look at this from a visual, the debt, there would have been a full fiscal year 2037, a full fiscal year 2038, and a full fiscal year 2039. And those have been shortened over time, and those annual debt service bars have been lowered over time through the use of refinancing at lower interest rates as the market has permitted. There's been years in the interim where the market, similar to this year, where the market just did not accommodate refinancing. So the district held serve, if you will. And that leads me to that upper right-hand corner of the chart. The WAC stands for weighted average coupon. So that's the remaining interest rate on the district's debt right now. And that means you're below 3.5% at 3.44%. And that is significantly low for any district, really, a very enviable position. And then if you go to that next line down, weighted average maturity, 5.7 years, that's also very attractive. That's where basically the midpoint of your debt service, about how far until you have half of your debt service completely paid off, it's about 5.7. So under 6 years is another strong position. But I will also state that while that's very strong currently, and flipping into these pages, and I apologize, I think the print on your screens is going to appear a little larger, and the ability to zoom in than here. Oh, thank you for zooming in on that. What's really highlighted here is that the district's debt service at this stage is legacy debt. And that legacy debt is what built out the district during the growth periods, right? Especially as we were in the late 90s and early 2000s. And then the newest component of the debt service is actually in the, excuse me, I hit the button at the wrong point. I was going to go for the pointer. Basically, and I hope that works. It's not going to show. Okay. So if you look at especially the larger issue, which is that 2020B issue right there. Yes, thank you. That is the newest component, which was for the STEAM addition and renovations to the high school building. So that occurred in 2010, and then a small cleanup piece in 2012. Both of those pieces at the time were done at very low interest rates, and actually you had the ability to refinance both of those pieces, so you were able to take further interest rate savings on those as well. Everything prior to that is sincerely legacy debt dating back, as far back as the 90s, with a piece that just paid off, as well as the, dating back into the early 2000, 2001, and 2003 in particular. And you can see that across the detail of the outstanding issues. And each one of those, I think it's important to note there, was amortized over a 30-year period. So the district did maximize the term. The other thing to point out there, and you can see it on the previous slide, and I'll just slide back there, and you can see where a lot of those bars for the color coding of each series, you can see how intense they are towards the back for each one of those series. And those larger bars represent more principal, where the smaller components of those colors represent either very little principal being paid off or all interest. So really, when the district built out its debt in that late 90s, early 2000s period, they did basically everything that was called a wraparound. So basically, it was deferring principal for as far out as you could go and just basically layering interest payments on top of existing debt service every time there was a new issuance. And that's why you see those bars as one solid color as you get towards the back end and that of each series. And that's, again, because of how far out that the principal was amortized. And I just wanted to point that out, kind of closing the circle on legacy debt, and that's what the district has outstanding. So I'll push pause right there for any questions on the existing debt profile of the district. Okay.
Just not a question, but will you touch at some point on because of what you just described, that's why restructuring debt doesn't make sense given, will you touch on that later?
I was going to mention that at refunding,
Okay.
but I can touch on that now.
Well, wherever
Dr.
it fits. That's
Okay,
good.
I can talk about that in refinancing for sure. So then what we'll do is we'll flip to, let's see, through that page. So this page here, which really is the history of the district's underlying credit rating. And when the district first started to build out, it was really, and that's the shaded gray area, you were really only going with the district's backstop through the state's Act 150 program of supporting its school districts. Should the district find itself in trouble and cannot meet its obligations of debt, there's a program at the state called Act 150 where the state will step in and basically withhold other payments that would be due to the district and have those reassigned to make sure that the debt obligations are paid first, and then the residual would flow directly to the district. Every school district participates in that, and that's between that and purchasing bond insurance is how the district went into the capital markets back then. When we were hired, we were brought on board in 2010, and we really saw the district's finances and where the district was headed, and we thought it made a lot of sense to go and get a standalone credit rating for the district. And that's where you can see the district came out of that with an A+ rating on a scale where investment grade ratings have B handles, or the triple B category, if you ever hear that in the media or see that in an investment prospectus. That's the low investment grade. Then you have your A category, single A categories, you have your double A categories, and it caps out at AAA. And AAA is the highest credit rating. Very few entities make it to pure AAA. If you are in the A category, you're viewed as solid investment risk. If you're in the AA category, you are in a very select group in the AA category of an excellent credit risk. And that's where you can see the district's progression through the A category into the AA category. And then in the spring of 2024, the district was put into AA flat. So it went from AA minus to AA flat. And something to also, you can see something that coincides directly with that is the graph or chart on the bottom right there. And the blue bars represent the fund balance of the district. And the red line represents the rating category. And as you can see, as operations improved and there were more reserves and more planning, the rating followed suit. So it's very much a direct one-to-one when you look at that. And that's something that the district has managed extremely well, and especially as you get that credit rating up. And why does that credit rating matter? That credit rating is very important because a district that knows it will need capital projects and need funding, you want the investment community to look very favorably upon you. Not only because you want them to put money aside to invest in the district's bonds when issued, but also because for every one of those credit rating levels, and I'm not just talking about A to AA, AA to AAA, or even below that BBB, it's the pluses and minuses and the flat. So within the rating category, we'll say AA. You have AA minus, then the next level higher AA, and the next level up is AA plus. Even when you get an outlook put on your rating, whether it's stable or a positive rating or a negative rating, that also kind of implies to the investment community which direction you're headed. And there is an interest rate spread in the capital markets put on not just that rating category, but also the mindset is there for an outlook. So that at any point in time, it changes based on market conditions, but that can be worth anywhere from 15 basis points of interest cost all the way up to 25 basis points of interest cost at times, depending on market demand and market pressures and market direction. But that becomes significant when you go to borrow. If you can save 15 basis points, 20 basis points just because of your rating alone, that also has helped the district, especially when you got out of the A category and into the AA minus rating level. You didn't have to purchase bond insurance any longer to get improved rates. So that not only interest rate savings, but your cost of issuance savings because of that credit rating elevating. So with that, I'll stop and offer up any questions on the district's credit rating.
I have a quick question. So when I'm looking at the chart, like it looks like you kind of have leveling off over years and then you go up. So since we were just upgraded, is there is that anticipated to stay steady, or is there something that can be done to push us to upgrade more, or is that not a realistic expectation?
Great question, and it can be done, but I would say for that to happen immediately, I think a couple of things would have to happen, and I will point to how long it took the district to get from AA minus up into AA flat. If the district added 50% more to its reserves, you would get a favorable outlook. And that's very simply put, it doesn't matter if you're a school district, a county, a corporation. The more liquid you are, the higher rating you're going to have, because they really look at you. If everything went bad in a heartbeat, how liquid are you to pay your obligations? So your days cash on hand is a significant calculation for the rating agencies, no matter what type of entity you are. So how could that go up quickly? If your reserves, let's say you added 50% what you currently have to your reserves. Would they come out probably over another rating cycle or two and say, wow, they hit the lottery and their reserves jumped? I think they're looking better. If you immediately paid off all your debt and had no debt outstanding and maintained the same level of revenue, the same level of reserves, they would look upon that, believe it or not, they would look on it somewhat favorably. They would expect you to have some level of debt service outstanding, but they would look at that because your liabilities have gone down. So your net metrics would turn to a potential increase or a credit positive.
And
but
Tony,
I-
if I just may,
Yeah,
so the
sure.
headwinds we're facing, it's a great question, but the headwinds we're facing is that we're not going to be able to save like we have. In fact, that's why I mentioned a 30 million, which is even what this, if you look at that bar, farthest bar right, the year 24, 25, but again, that's the year we just got the audit presentation on year-end June 30th of 25, $30 million fund balance, but that's really not the real number.
Right.
Current budget, June 30, 26, it's going to be closer to 20. So we're already at 20. That's really the number that we should have in our head. So we're not going to get a increased rating with the path we're on right now.
Right. I think my question would maybe be more clearly, I know like a couple years ago, probably during that flat phase, we were getting a comment on the rating. The S&P it was not necessarily negative, but they were watching a particular, I believe it was a bond, I'm not sure. Do we have something like that right now that we should be watching? Like, they're not liking this particular debt, so if we focused on that, or is that taken care of?
That is taken care of. I believe you're referencing when the district had a synthetically fixed deal.
Yes.
Basically, it was exposure to variable rate debt underneath.
Yes.
And that's what they were looking at, and they were citing that for that entire period. And that was fully matured and defeased. And the minute that went away, that bullet stopped showing up in your comments.
And they were looking at that even though the district had not used any of those funds to do anything. So we had sort of an insurance approach to that,
Yes.
and yet S&P was still holding us.
Right, yeah,
to it.
that's what I'm remembering.
Yes.
So that's in the past.
That's in the
Okay,
past.
Perfect,
So-
thank
and-
you.
Yeah, and I don't, the challenge with these joint governance meetings is that we only have an hour. And so we're already at 6:37. I just want to make sure time-wise, so we still have to get to the general fund budget update. Chris, how much time do you need for that?
I would say 10 to 15 minutes on
Okay,
that.
all right.
Okay.
And just real quick, this lists the general fund balance, so we'd have about $2.3 million worth of usage budgeted this year if we would add on the capital reserve. That's additional monies.
Okay. So thank you. So 12 minutes, Tony, no rush.
No rush, no pressure. Thank you, Mr. Kashani. And just to touch the headwinds part of that, another big thing that everybody understands, the rating agencies, especially here, is that the real estate revenues are challenged, not just for Pine-Richland School District, not just for Pennsylvania, not for Southwestern PA school districts, Allegheny County school districts. They have their own unique challenge when it comes to real estate revenues. But across the country, real estate revenues have been challenged coming out of 2020, 2021. A lot of reassessments in every metropolitan area when it comes to commercial real estate especially. So your cities, your counties across the country, that has been a very big point of monitoring, conversation with rating agencies and investors. So that keep that in mind. You're not, proverbially sailing that ship alone. So just something to keep in mind when it comes to ratings and projecting out ratings. So with that, we'll move into the refinancings. And with this on page 9, I didn't need to put together a full-blown market update and all the typical market graphs, simply because what we've seen happen this year, where everyone anticipated lower rates to come quickly, they didn't, in short. Where Mr. Juswick mentioned about the projected interest earnings, that is on the short part of the yield curve. That part of the curve did finally begin to move as we entered the fall of this year. And basically everybody was waiting for something to occur with the Federal Reserve, and they just kept everything on pause. Even though they did cut 100 basis points at the end of 2024, the market really didn't read anything into that. The market was really saying, we're not sure what that really does. That was nice that you cut the short-term rate by 100 basis points, but we're not really buying it. We still think we need to monitor economic data. There's more to come. We're not going to buy into it. Even though the market kind of had anticipations of it really impacting and lowering rates by as early as second quarter of 2025. The first interest rates cuts didn't happen until we got into the fall of this year. And what we did see was finally some traction in getting rates lower on the short part of the yield curve. And that's why we're starting to see some improvement in a couple of the refunding opportunities for the district's bonds, where we were almost at the same place this time in 2024, looking ahead. What did happen was short-term rates, say 10 years, 7 years and under, did get lower, not by a significant amount, but they did get lower. But we saw rates on the long end actually go higher. So basically a steeper yield curve is what we're looking at. The good news for the items listed here, especially items 1 and 2, and we'll focus on item 1, which is the series of 2014B. That issue is the closest to reaching the district's traditional savings efficiency threshold of net 3%. And right now we're at net 1.7. Believe it or not, rates really didn't move. These are basically the same results from the earlier look in October. Rates in the long end actually went up a little bit. Rates in the very, very short end within 2 years came in about 2 or 3 basis points. So really we're still in that same ballpark. But if we see this week, everyone's anticipating that the Fed will cut 25 basis points. If that, coupled with some of the other economic data, tells the market, okay, we think we're finally there where we're going to be heading into a period of lower interest rates, heading into 2026, if we see the market react and say, yes, we do agree with that, rates are going to come down, that issue's about 30 basis points away from reaching 3% savings. That could happen within a week, 2-week time period. No prognostication that it will happen, just that it could. And if it does, then the district would find itself looking very favorably at a refinancing of the 14Bs. And that, down below where I project out what would 3% savings look like, that means the district could achieve over $400,000 in net savings for that issue. The 15Bs are the next in line. Those are about 70 basis points away from projecting savings to the 3% level. The other issues are facing a little more of a challenge. And I'll point to that column in the middle, remaining average rate, being significantly below 3% for its existing interest rates. Right now, current interest rates in that part of the curve are going to be over the 3% threshold and right around 3%, and that's why those ones, you see a significantly larger move in interest rate. Plus, they're coming up on, some of them are coming rapidly upon final maturity. So you don't have a lot of runway to really achieve interest rate savings on those. But we will continue to monitor those, and should the market move in favor, then we would do that. And so I know earlier we had brought
Well,
up.
two things. One is the restructuring, but the other is, could you also briefly talk about what they'll see later tonight in the combined agenda for the parameters and then the bond council?
Absolutely, Dr. Miller. I'll first touch on the restructuring, since we're on the refunding. So restructuring, the concept of restructuring debt is where you would basically carve out debt that's coming due now, and you would push it out into longer terms than its existing maturities. That we did review that earlier this year. actually in the fall, and a couple of different versions of restructuring. And all of those basically point to you could lower the annual debt service payments now, but what we talked about really was the legacy debt. And what you would be doing by stretching it out is extending out those final maturities from 30 years. You'd be going out beyond 30 years on existing assets. And again, you can approach that out of need and necessity. It adds to the overall interest expense for those projects from inception. And that's one thing to consider when in that utilizing that mechanic in the market, if you will. And then there are a couple of other things to consider in that when you're looked at in the marketplace, when it comes time to restructuring, they're looking for an entity that is really struggling with liquidity and struggling meeting its obligations. There are districts, unfortunately, that rely on that more than one time. That they'll go to that well, every 5 years, every 10 years, dealing with something, and there are districts within certain parts of Allegheny County, certain parts of the Commonwealth, certain parts of the country, where there is no growth, lagging revenues, very, stagnant districts, if you will, and they really need that mechanic to really meet obligations and stay afloat. The market reads into that, the rating agencies read into that. So anytime that you would look into, we're going to restructure and basically throw debt service out longer than its current maturity. Again, they know that it's out there, and that there are certain times that entities need that. But they will also ask you the question right out of the gate, why? And when you answer that question, they'll ask the follow-up question is, do you plan on doing it again? My history with entities that have had to utilize that is always the second question, why, and do you plan on doing it again? And really what that does is puts in their mindset that if you are not going to address whatever the reason why is, then we're going to look to probably move on your rating and impact your rating that way. So there are a lot of things to think about when it comes time to restructure, but it is an option, and mechanically it can be done. And again, we did look at that, and it would be, from an interest perspective, it would be costly.
And also, to sum it up, would it be sort of a last resort when you're dealing with your debt to restructure and scoop and toss it out?
It would be, Mr. Jeswick, if it was a last option.
Okay.
So 2 minutes on the bond counsel services.
So in the bond counsel services, what you will see is in order to enact a debt incurrence resolution, the district would have to hire a bond counsel. The bond counsel will draft that resolution to present to the board for review. And within that resolution would contain parameters, whether it's for a new issue or a refunding issue, as to the term of the debt and the maximum amount of the debt. And that is to make sure that the district is in line with the DCED LaGuda Local Government Unit Debt Act that every municipal entity within the Commonwealth has to abide by. A government, a county, township, borough, school district. Everybody has to abide by that LaGuda. And so that resolution is going to make sure that you're in compliance, and to write that and to provide a bond counsel opinion not only on that resolution, the legality of it, the binding nature of that resolution, as well as if it's tax exempt, your bond counsel is the crafter of that and the guide through all of that. So your bond counsel will prepare that, make sure that it meets all of the criteria required, and then they will also, again, if it's tax exempt, what the district issues tax exempt indebtedness, they will also opine on your tax exempt status for that pending bond issue.
So in short, because the series of 2014B and 15, not as much, but because they're both now in this window of opportunity, that motion in the general meeting will be to allow you to get us more information so we can make that decision.
Correct, Mr. Kashani, correct.
Okay.
So Mark,
Yeah.
only because we don't get Mr. Massitti's presence here with great regularity, my recollection in prior conversations is that there is a scenario, and I'm not suggesting that it's one that we should follow, it's not one that anybody is recommending, but there is a scenario where we could do a greater refinancing to improve our debt, significantly lower the debt service, maybe by as much as $800,000 to $900,000 a year. It pushes the term out, and it will obviously increase the overall cost of that servicing that debt, but that is a scenario, so that as we look forward ahead and try to close a $2.6 million deficit, even if we go with a maximum tax increase, whether or not this board decides it's a good idea, it is an option that's available to us. Is that correct?
Yes.
Thank you.
That is correct.
Just so I'm clear, would you not have, so let's say that the issue is back 25 years ago, and that extends the debt well past the 30-year initial life. I thought you had mentioned some other analysis has to happen to determine that we can, because we would be basically further shifting principal from a 25 or 27-year-old issue further out, so we're paying more interest costs, which have an exponential negative effect on the community and district.
That's correct, Dr. Miller.
Okay.
There is that Laguda that I spoke of. Contained within there are parameters and guidance that you have to meet if you're going to extend debt past its existing final maturity, that you have to pass certain tests that only so much per year can be put out there, and it can only be extended so far. And you have to date that analysis back to the inception of the original capital projects funding issuance.
Right,
And
but again, as we tackle this budget coming up in this year, that's something that you could provide to us, and that's the analysis that you could do, and then it's something the board can evaluate as to whether or not that's a good idea.
Correct.
Well,
Correct.
so we have the analysis. I don't want to retread over. We have what we need in the last meeting we had. We have all the information we need as a board to talk about that further. I want to just be real clear. We're not going to authorize Mr. Massitti. The bond counsel services motion is strictly to look at refunding. 214B and 215B.
Yeah, and I wasn't
Yeah.
suggesting you go beyond that.
Right.
But I just want to make
there's
sure.
not, yeah, I just, no, and I appreciate, we had an in-depth meeting about that, different options. We kind of ended that meeting without any type of determination. We as a board could do that. I want to be clear. I don't think we need anything else from Mr. Massitti right now in terms of information. We have what we need from the prior meeting. We can go back as a board and look at that and talk about that. Okay. All right. 7 minutes.
Most of this is the different timeline and approach because of the special ed exception, so I think that's all he was really going to focus on, if you could walk through the dates.
Okay. So we're now going to go to item 2.03, budget update. Mr. Jeswick. Focus is the key word.
So what we want to do is, as we go through this process, is it's outside of our norm. For multiple years prior to this, we would pass the resolution not to exceed index, because we would like to keep the option open to exceed index through the special education referendum exceptions. We have to follow a little bit of a different timeline. When we look through the finance joint governance, what we put on this slide, it's 4 slides. What we have on this item through the board is the timeline for the special education.
So just to be clear, so the first file, yep,
Yes.
the
we got
first
a
file
slide for
in
it.
board docs, and then the fourth slide.
So we took the Act 1 timeline, took it as it went through our board meetings. So we need to put on our January 12th, 2026 preliminary 2026-27 preliminary budget information item to the board. So we go through all the proper timelines of giving public notice of intent to adopt. Then on the February 9th meeting, we would put the preliminary budget adoption. In this, we would be asking for the special education referendum exceptions, which through my calculations right now, would allow us an additional 1.7%. That will be based on whatever our assessment value at the time is. We track that weekly as we get updates on the community profiles website through Allegheny County. As of the 12th, I would have to upload that preliminary budget to PD and advertise the intent to request the referendum exceptions. And then as of March 5th, we will know what PD allows us. If they would allow us up to that max we requested, at that point within the max we requested, that does not tie us into anything, but gives us the additional options for the revenue.
Okay, so let me try to summarize that. So this would be the special ed referendum exception.
Yes.
If I heard you right, you're saying we would apply for or ask for another 1.7% above the 3.5.
Correct.
So it doesn't mean we would do it, but it would give us up to 4.2, if I do the math in my head correctly. 5.2. See, I don't do math in my head. That's why I always, as an engineer, you have calculators. So, okay, so we would have up to 5.2. That would be our permitted max if we get the approval.
Yes.
Okay. I just want to make sure we're clear on, this is more of a process, it's a procedural thing. This is the first time we've done anything specific for special ed in my time. So it's a very unique thing that we're doing.
Yes. Perfect summary.
Okay, so any questions on that? I want to go back to the bond refunding, Mr. Mercedes. What we discussed at the very end, thank you, Mr. Justman, that approval for the counseling service, that is what we've done with every refunding that we've looked at. So I wanted to make sure there's nothing unique about that. It's a common thing that we've done over the years when we've looked at this. So.
Correct. Very standard for every district. Has to go through the resolution process with bond counsel, no matter if it's a refinancing or a capital projects borrowing. You have to do that even if it's a note borrowing, a full-blown bond issue in the public debt market. All of that has to be done through a resolution authorized by the school board and guided and prepared by bond counsel.
Okay. Once again, thank you. Thank you for coming. And are you going to stick through? You going to head out after?
I can stay as.
Well, you don't. No. It was more for because I wanted. So when we get to the general meeting, we can talk more about the finance stuff there rather than as a board. So I'd like to just maybe go to audience questions and then we can wrap up. Okay. All right. Thank you, Tony.
Thank you all.
Okay, with that, so 3.01, recognition of visitors. Do we have anyone? I always look for you over here still.
We have one person in person,
Okay.
nobody online. Kathleen Ravati.
Okay.
Hello, Kathleen Ravati from Pine-Richland, Pine Township. Just a couple quick comments on the budget. Very interesting presentation. Lot of emphasis on the reserve fund. I think one of the things this district and the board needs to remember is that reserve fund is primarily built on the backs of taxpayers. And Pine-Richland has one of the largest reserve funds in the area, in Allegheny County, in terms of comparable districts. And that this ranking isn't based on relative amounts, but based on a percentage of operating revenue. I don't have the most recent numbers. I couldn't pull up the advanced materials this evening before I got here, but if you ballpark that the reserve fund is at about 30 million right now, that puts us at about 28% of operating revenue. North Allegheny has a 14% reserve fund. North Hills 13, Shaler 8, Mount Lebanon 4, Hampton 6. So it begs the question of when we're looking to solve what I don't think is the bottom yet of the impact of CLR, we cannot keep turning to the taxpayers to fund what I see as opportunities that have not been fully explored for expense reduction. This is not to say that I think that the administration has not looked everywhere they can in terms of what to cut from academics and that they haven't already done some of that. But both things can be true, that has been done and that it's still not enough. The word unprecedented times was used a few times over the year to talk about this impact of CLR and the fact that as a district, we've never had to deal with declining revenues or budget shortfalls. The last time I heard that phrase used was during COVID, when we had the shutdown. And what the board and the then board and the administration did at that time was they brought in a special committee, handpicked by nobody really knows. They met in secret and came out every 2 weeks with an edict about what was going to happen with respect to school closings, masking, social distancing. You have plenty of people in this district that do turnarounds for companies. They're they probably work for private equity funds. They know how to look at what is essentially a company, because that's what this is. You just have a different product. Your product's education, and can find ways to attack expenses that I honestly don't think have been looked at yet. On the backs of the Allegheny County tax increase that we just recently all incurred, one of the largest teacher raises in the history of this district, or at least in recent history, the Jumbotron, the planetarium. I don't know how you can in good faith say we have maybe enough to bridge this year from our reserve funds, yet instead we're going to go to the taxpayers. You can't keep doing that. I don't think we've hit the bottom of CLR. It looks like it's leveled off. We don't really know yet.
Your 3
So
minutes have
I would
expired.
encourage
If
this
you could
board,
please finish your thoughts.
I would encourage this board, in addition to the items that you've already listed for the general meeting that you're looking at, to consider some of these alternative expense strategies. Thank you.
Okay, thank you, Mr. Ravati. So there is an attachment, not in this meeting, but there is an attachment in the regular meeting that I will revisit. The new board will be the first time you've seen it, but it is a historical snapshot that I started once upon a time. Mr. Justwick has helped me keep it current. In 13 years, we've had one tax increase, 1.97%. I can attribute every dollar of that increase to what we've saved to pay for our capital projects that are coming up, rather than take out debt. We've been extremely prudent and good stewards of our finances. So I will revisit that, and once we pull it up, we can talk through those numbers. But thank you. That'll be, we'll call the joint governance finance, or the finance meeting, and want to take a few minutes or jump right in? Okay.
Mr. Hawkins coming up.
Okay. Yeah, I'm good to jump right in.